Hey, John Higgins here, Mortgage One. Happy Monday. Just want to give you a quick update on the interest rate market and kind of what our economy is doing. So, over the last week, we've seen more inflation numbers come out, and they continue to be some eye popping numbers. We haven't seen inflation at this rate really since the early 80s, late 70s. And although a lot of the experts were expecting this last read here for June to kind of show maybe a peak in rates and a little bit of a rollover, instead, all the numbers seem to be a bit higher. There is a little bit of good news inside of that. So even though the core rate of inflation is running over 9% right now, which is astounding compared to what we've seen over the last 30 years or so, the core rate, if we kind of take out food and energy, is actually starting to show a little bit of a top. So energy, oil prices, gas prices, as we know, really kind of trickle through the entire economy. And some of the numbers that we see on the inflation side, it's difficult to separate oil out of the equation. But the best gauge that we have, which is the core rate, does show a little bit of improvement there. So, maybe a dose of good information buried deep in there. What is that doing to the interest rate environment? So, interestingly, the Fed continues to beat the drum of more rate increases. We're looking at either 0.75% or a full percent at the next FOMC meeting. A full percentage point, we haven't seen that in 40 years. So, that would be a big move. 75 basis points, again, seems to be built in. This is telling the market that the Fed is going to push the economy into a recession. We may actually already be there. It looks like we're going to have a second negative print here in the second quarter, but long term, it looks like the way the Fed is going to get inflation under control is basically to dampen down demand in such a way that's going to push us into recession. So that is just one of the inevitabilities of what the Fed's doing. What does that mean for interest rates? Well, the bond market that controls interest rates, especially on the long end, is looking out quite a ways. So they're looking into 2023 and 2024. And we've seen that top that we've talked about in previous updates at that 3.25, that held. And we've moved lower. We're back at or below 3% here for the last week or so. So it looks like, at least the increase in interest rates that we've been seeing, which has been unrelenting for the first part of the year, has stopped. I don't anticipate rates going down tremendously, but to get a top put in and kind of see the rate stabilize is very welcome. So this week, we've got some employment numbers coming, nothing major. We have some housing numbers coming out, and those are probably going to be a bit on the weakish side, especially with home builders. But from the interest rate side of things, it looks like we've put in a top, and these rates hanging around 6%, a little bit above, a little bit below at the moment, should stay for a bit. So hope you're having a great week. If you need anything, certainly give us a call. Have a great day.